So our mission for you today is really to pull out the most important nuggets of knowledge from this, well, it's a pretty technical document. We want to help you understand not just what's allowed or forbidden in Islamic currency trading, but crucially, why these differences matter so much in the world of Islamic finance.
Okay, so the big question right out of the gate many might have, is currency trading even allowed in Islamic finance at all?
Hmm.
I mean, I could see some listeners maybe assuming it's completely off limits, given the focus on tangible assets. What does the standard say?
Yeah, that's a common thought, but the standard is actually quite clear. Currency trading is permissible. But, and this is a big but, it comes with very strict Sharia rules and conditions. The most crucial ones are about mutual possession, basically. Both sides have to get hold of the currencies, or constructively, before they walk away from the deal. And if you're swapping currencies of the same type, like dollar for dollar, there's a strict rule for similarity or equality.
Ah, okay, so that similarity rule for the same currency type, that sounds like it connects to preventing hidden interest, right?
Exactly. That rule is essential. It's there to stop any kind of riba or interest from sneaking into the exchange and make sure it's a fair, immediate, equal swap. Keeps the transaction clean. And just as important are the things you can't do. The guidelines explicitly forbid putting in an option clause or setting a term for delivering one or both currencies later. Both of those basically add uncertainty or future betting into a deal that's supposed to be right here, right now, settled.
Right. And beyond just the mechanics, I see the standard also mentions broader ethical things like monopoly or causing harm. How do those play out in currency trading?
That's a really vital point. The principles aren't just technicalities. Transactions shouldn't aim for monopoly or lead to harm. This really speaks to the bigger picture of Islamic finance, making sure trading doesn't exploit people, mess up markets unfairly, or concentrate wealth in bad ways. It's like an ethical filter. Now, while this standard goes deep on things like possession, dealing with debts, online trading, it's worth noting what it doesn't cover. It's really focused just on currency exchange. So stuff like trading physical gold and silver or just sending money without an exchange, those fall under different standards.
Okay, that initial clarity is helpful, but here's where it gets, well, really interesting for anyone who knows the global financial markets. Our source makes a very strong statement about the forward currency exchange market. That's a huge tool in conventional hedging.
Oh, yes, it's absolutely unequivocal. The standard declares that dealing in the forward currency exchange market is absolutely forbidden. It's not just a minor rule, it's a fundamental principle. It basically avoids speculation and uncertainty, what's known as gharar in Islamic finance. Forwards, by their nature, involve uncertainty about future prices, and that's the issue.
So if institutions can't use those standard forward contracts to protect against currency swings, what are they allowed to do? How do they manage that risk?
Well, the standard does offer alternatives for institutions to hedge against, say, future currency depreciation. One way is making reciprocal loans in different currencies without interest. But critically, the two loans are not linked, can't be a condition of each other. Another allowed method is buying goods or concluding murabaha operations in the same currency.
Okay, you mentioned murabaha operations. Could you just quickly unpack what that means for listeners?
Sure, absolutely. Murabaha, in simple terms, is a cost-plus sale. So instead of just swapping currencies for a future date, an Islamic bank might say, buy a real asset, maybe a commodity, and then sell it to the customer at a price that includes an agreed-upon profit. Often the payment is deferred. This really changes the game. It shifts it from a pure money-for-money deal, which is iffy if it's delayed or speculative, to a legitimate trade involving actual goods. That's permissible. It really highlights how Islamic finance tries to tie finance back to the real economy, away from just abstract money games.
That distinction is really clear. Now, about this possession idea in currency trading, especially today, it's hardly ever about physically handing over cash, right? In a world of digital entries, what does possession actually mean according to these standards?
Right. Possession is absolutely key, and the standards are pretty practical about it. It can be actual possession, the straightforward hand-to-hand delivery. But much more often in modern finance, it's constructive possession. That just means enabling you to actually use or control the funds, giving you disposition. The standard gives clear examples.
Okay, like what? Can you give us some specifics of constructive possession?
Yeah, for instance, when a bank credits an amount of money to your account, that counts as constructive possession. This works if the money is deposited directly or through a bank transfer, or if you enter an immediate exchange contract right then, or even if the bank deducts money from your account to send to someone else. Now, the standard does acknowledge that sometimes there's a customary delay for the bank credit to actually process, for you to actually get the money. That's considered excusable. But, and this is crucial, the beneficiary is not allowed to dispose of the currency until the effect of the bank credit occurs. So you have control flagged, but can't spend it until it's fully processed.
Okay. Are there other common examples? What about things like checks or paying with a credit card?
Absolutely. Getting a check counts if there's actually money backing it in that currency and the bank has earmarked that amount for the check. Also, think about a shopkeeper. When they deliver the payment slip you signed with your credit card to their bank, that's considered possession for them. But the condition is that the credit card company has to pay the shopkeeper without undue delay. It all comes back to having effective control pretty quickly.
It's really fascinating how they adapt to these modern tools, but still hold on to that core principle of possession. Now, speaking of modern ways, what about using third parties, like brokers or agents, and trading online? How do the standards handle that?
Agency is generally allowed. You can use an agent to make the deal, take possession, deliver the currency. However, there's a strict condition attached. The two principals, the actual buyers and sellers, must not separate before the two agents complete possession. This makes sure that immediacy principle holds up, even when agents are involved. As for modern communication, like online platforms, the standard says contracting this way has the same effect as doing it face-to-face in one place. But the contract itself is only really sealed upon acceptance and actual or constructive possession. So even online, that immediate control element is absolutely vital, still non-negotiable.
That makes sense. Okay, now let's talk about promises or future agreements regarding currency exchange. This feels like it could get tricky, especially with this concept of muada. What's the deal there?
Right. The standard draws a really important line here regarding promises, or muada. A promise is forbidden if it is binding on both parties. Why? Because a binding promise from both sides basically creates a future obligation for an exchange that should be immediate. It starts looking like a forbidden forward contract. However, a unilateral promise is permissible, even if it is binding. So if only one side promises, that's okay. This avoids the risk of that locked-in bilateral future deal that Shari'ah wants to prevent.
Interesting distinction. And what about this thing called parallel buy-sell? That sounds like it might be a sneaky way around some rules.
It might sound like it, but nope. The standard explicitly forbids parallel buy-sell. And it gives clear reasons. Typically, it involves non-delivery and non-receipt of the two currencies right away. It often means stipulating an exchange contract within an exchange contract, kind of nesting them. And crucially, it usually involves a promise binding on both parties, so it hits several red flags. Also, it's not permissible for one party to offer an obligation to the other to protect them from trading risks if that protection is baked into the contract itself. But here's a nuance. It is permissible for a third party to volunteer that kind of risk protection as long as it's not part of a prior agreement. The key is avoiding building risk mitigation into the contract itself in a way that mimics prohibited structures.
Okay, that clarifies a lot of those fine points. Let's shift now to how currency exchange works with existing debts. And also, what specific things should financial institutions definitely not be doing?
Sure, when you're dealing with exchanging currencies related to existing debts, it's allowed if it results in settling things immediately, basically extinguishing the two debts involved in the exchange. This could happen by offsetting the debts if they cancel each other out, or if a creditor collects their debt in another currency.
Yeah.
But the condition, again, is immediate payment at the exchange rate of the day of payment, always back to that immediacy.
Got it. And simple bank transfers involving different currencies, is that generally okay?
Yes, it's permissible to make a bank transfer in a currency different from the one the customer initially provided. The key condition, as always, is that actual or constructive possession of the currency occurs through bank credit. As long as the funds become effectively available, it's fine. And yes, it's perfectly okay for the bank or institution to charge the customer a transfer fee for doing this. That's seen as a charge for a service, not as interest.
Okay. And finally, what are the absolute no-goes for the banks or financial institutions themselves? What practices should they avoid facilitating for customers?
The standard really flags two main prohibited forms of trading they need to steer clear of. First, it forbids customer trading with amounts more than what they own. This is basically talking about leverage trading or margin trading without sufficient backing. It exposes the customer to way too much risk. Second, it's forbidden for an institution to lend the customer amounts conditional on dealing in currency trading with them exclusively. This prevents a situation where the customer feels forced to trade only with that bank just to get the loan. It's about avoiding coercion. However, an important point, if the institution does not stipulate this exclusivity condition, then lending itself isn't prohibited in this context. It really hinges on whether that condition is attached. Fairness and preventing undue influence are key.
Wow, what a deep dive.
Yeah.
It's really clear that Islamic finance doesn't just ban currency trading. Instead, it layers this precise ethical framework over it. It seems designed for fairness, transparency, and really cutting down on undue risk. It's quite a blend of ancient wisdom and modern financial reality.
Exactly. And these standards really show how you can meticulously apply traditional principles to complex, modern financial tools. They offer clear, practical guidance for everyone involved. And this brings up, I think, an important question for you, our listener, to think about. How might these core principles, transparency, immediate exchange, avoiding excessive risk, how might they apply to other areas of finance, maybe even to some of the newer financial products or digital assets that are popping up today?
Definitely something to chew on as you navigate the financial world, hopefully feeling a bit more well-informed now. Thank you for joining us for this deep dive.
Thank you.